All right, welcome to this episode of TNT. Today we're actually just going to take a step back. We're going to talk about real estate investments, but from a different angle today. We're going to talk a little bit about REITs and what they are and how to invest in them. One of my favorite quotes is, "Compound interest is the eighth wonder of the world." In fact, if you looked up on Investopedia, if you were to get a 5% annual rate of return, your investment would double every 14 years. Something to think about. We'll get into this on this episode of TNT. Okay, before we begin talking about REITs and specifically how to use them and investments, I would like to just take a second and back up on what I mentioned before, which was that Investopedia, if you were to get a 5% rate of return on an investment, they say your investment would double every 14 years. Well, now, what is that? That's called the Rule of 72. It's a rule of thumb. It is not a precise exact measurement, but it holds true for the most part until you get to significantly higher rates of return. So how does it work? Well, you take the number 72 and you divide the rate of annual return that you're getting on an investment into 72, and that gives you the number of years, theoretically, it would take for your investment to double. So, as an example, if you had a 9% investment, so you would take 72 and divide that by 9, and then the result would be 8 years. What is a REIT? This is where it all starts to come into play. A REIT is a real estate investment trust. One of the things that I hear very often from people is, I don't have a down payment. I don't know, I can't invest in real estate right now. Well, that's just not true. You can invest in real estate, you just won't be directly investing in real estate. You can invest into a real estate investment trust. This was invented under President Eisenhower under the cigar excise tax extension of 1960. It is basically a trust or a company that owns, operates, and finances income-producing real estate. It is a pass-through entity, which means that taxes are not paid at the corporate level, but paid at the individual level. Now, why? Well, it's nothing nefarious. It's not corporations skipping out on taxes. It's very similar to an LLC, and investors pay taxes on the proceeds that they are given to them. Now, there are some basic requirements to operate as a REIT. You must invest at least 75% of the total assets in real estate. You must derive 75% of its gross income in rents from real property, interests from mortgages or financing of real property, or from the sales of real estate. You must also pay at least 90% of taxable income in the form of shareholder dividends each year. And some companies pay as much as 100%. So these are great ways to invest into real estate and still be able to reap the benefit of a passive income portfolio. Now, this entity is taxable as a corporation. It has to be managed by a board of trustees. It has to have a minimum of 100 shareholders. And it may not have any more than 50% of its shares held by 5 or fewer individuals. Sound familiar? That's because it is. It's the same structure as a mutual fund with managers. What do REITs do? Well, they pool funds together to acquire real property to collect income. Where does this income come from? Well, the income comes from rental income and interest payments, appreciation, and some of them actually get it from harvesting, such as timber, believe it or not. This also allows investors to invest in real estate or a portfolio of real estate without having to buy, manage, or finance the property. This is huge. Now, there are very real estate types, and I'm moving rather quickly here, so if you need to stop and go back, please do. Now, the first way we can break down the different types of REITs is by its investment. And what I mean by its investment means, are we talking about the equity, the debt, or a hybrid of the two? So equity is actual cash investment into ownership of a particular piece of real estate. The debt would be any kind of financing, mortgages, or anything else that would be a note on the property in which you would receive interest income from. And that is also known as a mREIT, by the way, or a mortgage REIT, or a hybrid between the two in which you're using both equity and debt to gain income into the REIT. The next way to approach this is by sector. We can break down a type by sector, and what that means is different types of property that we have available to us for different purposes, being office, industrial, retail, lodging, residential, multifamily, healthcare, self-storage, data centers, even infrastructure and timberland can be qualified as a sector in which REITs can invest in. All right, so one of the last ways that we can break down a REIT is by its market type. Now, what do I mean by a market type? Well, there's two very major factors in there. The first one is whether it's public or private. So what is the difference? Well, the difference between a public and a private company is one is regulated by the SEC and one is not. That's the fundamental difference between the two. That said, it can either be publicly traded, like on a stock exchange or on an open market exchange, or it cannot be publicly traded and it's considered an exclusive access type of instrument. It's just not on a public exchange, but you can still buy into it by making investments into that company. Okay, let's go through these really quickly. There are three different types that are primary here. The first one is publicly traded, which is regulated by the SEC. It is listed on a public exchange, so that could be the NASDAQ or the S&P or the Russell. It does have high liquidity. Why? Because the shares of stock are there available for trading at each given moment of the trading session, which gives it high access. Now, a publicly non-traded company is still regulated by the SEC, but it's not listed on a public exchange. It has very low liquidity and it has varying access, meaning that it's typically a relationship-based access in which you are either seeking out the company in which you would like to invest in, or through relationships or through fund managers, they are investing on your behalf. Now, the last one is called a private REIT. Private REITs are not regulated by the SEC at all. They still have to subscribe to all of the tenets of what makes a REIT according to the IRS regulations, but they're just not listed on a public exchange. They have very low liquidity and very limited access. Can I invest with my IRA? Yes, you can invest with your IRA, because if it is a publicly traded REIT, you can invest with your IRA because you have access to it through the stock exchanges. That said, can you invest with a non-publicly traded REIT? Can you use an IRA? Yes, you can use an IRA, but they are generally done on an individual basis through custodial companies. What does that mean? It means it's a separate IRA firm and company that's contracted specifically to handle and deal with the REIT. So it's a separate IRA account. Still falls under the deductions and everything you need, just separate company. So that said, when it came to private REITs and public non-traded REITs, there was a general gap in being able to raise funds. Now, private REITs typically still fall into this category where you need to be an accredited investor, but public non-traded REITs had the problem of trying to raise capital in order to do their individual deals. These are typically smaller REITs rather than not being the big ones like Public Storage comes to mind as an example. Okay, that led to the creation of the eREIT, which was basically a crowdfunding REIT under the Jobs Act of 2012 and was signed into law by the president. This allowed for investment into more publicly non-traded REITs by accredited and non-accredited investors. Online real estate investment platforms were allowed, created in order to facilitate these kind of non-publicly traded REITs. And they still hold to the same standards. So there's still a longer term investment. They are less liquid, just like the other non-publicly traded REITs, and they are regulated by the SEC. Now, there were two that came about pretty quickly in the early 2010s. The two that really have risen to the top is Fundrise and Realty Mogul. There have been others that have come out since then, but those are the two big dogs, and those are kind of who coined the term eREIT, if you will. But it's basically an online platform that allows them to crowdsource different investors for their investments. You need to be savvy if you're going to go the route of investing in an eREIT. You need to know at least some level of investment experience in being able to read a prospectus and figure out whether or not this is right for you. If you don't know, they'll be there to answer your questions and help you, but for an eREIT, you do need to spend a little bit more time on it. Now, a couple quick notes, housekeeping notes, just so we're clear here. I am not a licensed securities dealer, nor giving you advice on any of the securities that I've mentioned. As I have mentioned them, these are for example purposes only. I am, however, a licensed real estate broker and can speak to the practical lessons of REITs. I am CCIM, or Certified Commercial Investment Member certified, and I have a thorough understanding of analysis of real estate investment. All right, wrapping all this up and putting it together. Why did I begin talking about compound interest? Well, when I have buyers and investors who say, I just don't have enough capital to invest in real estate, it's just not true. You can invest in real estate with as low as $30 for one share of REIT on the stock exchange, or you can invest as low in an eREIT as low as $500 to $1,000 to start for that type of platform. There are investment vehicles available to you out there. Now, how and why would you choose to do that? Well, let's say if you're building up a down payment and you know, using the rule of 72, that if you have a certain investment and you were going to add to it over time for a period, you might have the down payment you need for an investment property within X number of years. 2, 3, 5, it's up to you. I hope this helps. I hope that you found this primer and introduction into REITs and on alternative investment vehicles into real estate useful. Leave your comments and your questions below. I would love to hear what you have to say, and I'll catch you on the next TNT.